I'm going to invite our panellists now, because we're just going to talk about what the economic crisis does mean for the housing market. So I'll introduce them up on stage, and I'll get them to introduce themselves to you. So first of all, let's welcome Miles Shipside, co-founder of Rightmove, of course, high street agent prior to its launch in 2000, and we've met many times on the telly and stuff, so had quite a few good conversations. So welcome, Miles. Gráinne Gilmore as well, who is former Knight Frank, Zoopla, now Clutton's housing market research expert. Welcome, Gráinne. David, you know. John Hards. Welcome, John. You'll recognise John, I'm sure. Amazingly experienced senior estate agent who, of course, helped grow and lead Countrywide, which, until being sold to Connells this year, was the largest estate agency in the UK. And last but not least, Nathan Emerson. Welcome, Nathan. Former estate agent, decades of experience, CEO of the industry's largest trade association, which represents the vast majority of the UK's 19,000 branches. We have water. We have Slido. Thank you to Big D, whoever said love the dress. It's a jumpsuit, but thank you very much. Lots of you bringing in questions. Please do keep them coming in. We've got some views here already, so that would be great. I thought it would be really useful, perhaps, to just get everyone to introduce themselves and just give a couple of minutes. Where are you at? We heard, David's kind of semi-optimistic, I'd say, outlook on the economy. But in terms of business, Miles, where are you at?
It's a really hard one to read. Obviously, it's early days, even though a lot of people are coming out with predictions already. Some of them, I think, are far too early and irresponsible. And obviously, in today's 24/7 media world, they're all seized upon. So sometimes it becomes a self-fulfilling prophecy. I think the worst industry forecast so far is Savills at 10% drop in 2023, but then amazingly a 1% rebound in 2024. Now that's a very quick turnaround, and I think probably most of us would take that. A 10% drop means greater affordability for stretched first-time buyers, and then amazingly a recovery in 2024. I don't think, in my experience, and I think one of the reasons that probably John and I are here, we've seen a few downturns between us. And upturns as well. So the demand for housing, it has been resilient. We've had, obviously, Brexit as a challenge. We've had pandemic as a challenge, and housing has come through. So there is the underlying demand there, but we've had a major blow to confidence. Interest rates were going to rise, but it's been a shock. So I don't think it's going to be anything like the 10% of Savills. But let's face it, price rises were unsustainable, so a slowdown was always going to come. A readjustment in affordability is important, but they are painful. So the industry needs to act quickly and sensibly, and hopefully has got the skills, and we'll probably come on to that later, to cope with a tougher market, having had 2 years of really unexpected boom, as David said.
Really interesting, yeah, and we'll definitely come on to the skills needed to kind of act quickly and counter the kind of gloom. Gráinne.
Thank you very much. Delighted to be here. So one of the key factors we have to remember when we're thinking about the market today is just what we've been through in the last 2 years. Now, I'm sure at Rightmove as well, and at Zoopla certainly, we saw the demand for housing start to grow during the first lockdown, and it hasn't let up since then. So we have seen double-digit growth in some areas of this country for 2 years running, and as Miles says, levels that were perhaps unsustainable. But what it does mean is that we are a level of house prices that even if we see double-digit price falls, we may only be going back to levels of house prices early 2021 or even late 2020. So we have to just remember what we've been through when we look at the headlines looking forward, saying, oh, there might be double-digit growth, but that may only take us back. We may not even be back to pre-COVID levels. The other thing to remember, and I'm sure David touched upon it, is we enter this market having done a lot of stress testing on borrowers. So everyone who's bought a home in the last 7 years or so has been stress tested to within an inch of their life. I mean, people asking, why do I have to prove that I can afford 7% interest rates? They're at 0.5. Now is the reason that we've done that. So hopefully a lot lot of homeowners won't be forced into having to make any sudden moves because their incomes are at a level that they can afford this level of price rise. The final point I would make is the political upheaval we have seen in the last 2 months is just unprecedented. And a lot of it had a direct impact on our market. But I feel now that we've got through the autumn statement, the gilt markets didn't react too much, the money markets that determine mortgage pricing didn't go haywire. So we may be into a period of more stability now. If we think that mortgage rates are coming down, we could see some buyers maybe sitting on their hands until they're sure, but any sort of sign of mortgage rates coming down is good for our market as we move into 2023.
You're optimistic then.
We're still going to be forecasting that prices will come off next year, but given where we were in mid-September, I feel we're in a better position now than we were then.
Cool, thanks, Grania. John?
Thank you, Noga. Yeah, well, I'm with you too. I think it's quite a positive outlook. It's going to be tough next year without a doubt, and we'll see something come off house prices and and the volumes of stock sold. But overall, I think what we've heard from David is quite a positive outlook. It's going to be a shorter term than we may have heard in the press as such, or that speculation is. And I think, as you said, the house prices may come down, but look at how much they've gone up recently. So I think, and with the process to borrow money today, it's much tougher to borrow money. So I think there's much safer. And if you look back at the 2008 recession, people have been borrowing money way beyond their means. And then when we had that financial crash, it really crashed the market. So I think things are quite different today. I think what we have to bear in mind is there are always drivers in the market. There's the 3 Ds, which is death, divorce, and debt. And so there's an
Sorry, John, I just missed the first couple of Ds. I got divorce and debt.
Death, divorce, and debt, which sort of gives an underlying volume to the market. Probably about 50% of the market. I mean, David's slide showed us with averagely about 1.2 million properties sold a year. And about half of that, 50,000 a month, comes from those 3 things. So the rest of it is sentiment. And I think providing we have good employment and good sentiment, we'll see a reasonably robust market, bearing in mind what's going on. So I think that the one thing that probably we're not touching on at this stage is the rented market and how the pressure is being put on the rented market with the squeeze on landlords. And we'll see, I read the Right Move numbers this morning that there are something like 36 tenants now for every rented property on the market, which is bound to drive rents. And we're first-time buyers, not buying, so they're going to go and rent. So I think that we should be mindful about where the rented market is. But that's my sort of initial thoughts.
Yeah, we'll definitely look at the rental markets. We haven't touched too much upon that there. And keep your question. Oh, lots of questions coming in. Thank you very much. Nathan.
I'm going to add another layer onto these fine fellow panellists. I think all of the key components of the jigsaw are there. They're a little bit jumbled at the moment, but things are settling down. And I think this is an area where, for me, it is about sentiment, but it's also about confidence. And it's us being strong enough to continue to talk about the positives in the market. We know that sometimes the media can naturally pick up on various facts and figures, and that can sway public opinion massively, a public opinion that we then have to deal with on a daily basis.
Are you saying the media is unhelpful, Nathan?
No, not at all. Quite the opposite. I think the media actually helps us focus. I think it helps us with debate. But I think what it also does is it channels those issues to the forefront that enables people to start talking about it. If we don't deal with issues, if we don't deal with rented, and we don't look at interest rates, and we don't look at inflation, and we're not aware of the effects that they can have on a micro level and on a large level, then things never get dealt with until it's too late. So no, I would go the other way. I actually think that's very healthy because it encourages debate and it encourages focus. I think where I would be is there are a number of consumers out there which we interact with on a daily basis, and sometimes what they do need is a wider picture than individual statistics, which can sway. Probably back to the skip analogy, really, I think is superb. We are interacting with the public, and how we portray ourselves to the public will have an effect on how that marketplace delivers itself, really. The components are there. I'm not concerned that we'll make it through. We've made it through much worse scenarios in the past with more challenging obstacles. We've got employment, we've got liquidity in the market, people have got more equity in their homes than ever before. So by and large, everything's in the right place. There's a big confidence factor here that probably just needs to be tackled, really.
Okay. And David, of course, we've heard your thoughts already. One of the questions that's come through from Mal, and I just anyone dive in. Let's kind of get numbers out, shall we? You say that sales transactions will fall. By what percentage overall, and when will the trough be? Has anyone got a thought on that?
Grania will be good on that.
That's anybody's guess.
Yeah, but it's a guess, but it's also a business kind of strategy as well. It's how you prepare, isn't it?
It's difficult. I mean, I was thinking before about coming today, and you think, well, in the pandemic, I would have predicted a proper crash. But actually, the government did a few tweaks, and confidence was there, and we saw property prices rise. I would guess you're looking at 10% fall prices and volumes is my sort of gut feeling. I don't think it's going to be massive. When we saw the 2008 recession, the volumes went from the average 1.2 million down to 790,000 as the low point, and it actually had a run rate during the 2009 at 600,000 transactions, which is really rock bottom. I don't really see us going back there at all. I would think that we're going to be a shade off the million, that's level, so and we'll be quieter next year.
And I know, Grania, you touched upon this because you said that the stress tests now are so much more rigorous.
Yes.
So that in some ways protects, the market and borrowers as well. So that's why, is that kind of your opinion, is that we won't see it as bad as it had been before?
Because it's the homeowners who then might get into some distress, and it's when you have forced sales, that's when you can start to see a rapid decline in prices. But one thing I would add is I'm not overlooking the fact that the household expenses are also rising. And again, that's an added impact that we haven't had before in the market, really. There's this whole other thing going on where household finances are also under increasing pressure. So I'm in no way minimizing the pressure that some households will be under, but it's just that they will have tested that their income can deal with higher mortgage rates, even higher than they are now, if they have to come off their current fixed deals. A lot of homeowners have no mortgages. A lot will sail through this period on a fixed rate. But those people who are coming off, I'm not minimising the pressure they might be under with everything else that's going on, but the likelihood of us getting to the period where we were in the financial crisis, where Bradford and Bingley were offering 125% mortgages, and then the bottom fell out, it's not going to be at the same level as that, in my opinion.
And David, I know you looked at kind of the skip analogy, but this is the difference, isn't it, in terms of this cost of energy, cost of living crisis that people are facing now?
Yeah, I mean, it is. And if you think about it, over the past year, household energy bills have gone up by 70 to 80%, and will go up by another 20% in April. But also, food prices are rising by around 16%. So and Grania is right. The combination of higher mortgage rates and all those other things, I suppose the difference is, I mean, if people are thinking of alternatives, unless the alternative is to move back to live with their parents, they're going to face those additional bills wherever they live. So if you're in rented accommodation, you face that as well. But so I think it is a real challenge. I mean, I think those things are interesting. But I think, John, isn't it the case that the transactions used to be much higher than they are now? I mean, even the 1.2 million is much lower than we were used to in the past, yeah.
We have seen them much higher than that. And in fact, in 2007, they probably peaked at about 1.7 million. It was huge. However, 1.2 is about the average. So
we hit 1.5 in 2021, didn't we? We hit about 1.45, 1.5.
And this year is probably looking at 1.4, isn't it?
But stamp duty holidays, everyone coming out of COVID, it just all amalgamated to get to 1.5.
Certainly from a business point of view, don't base your business on the last 2 years.
No.
The long-term average is around 1.1 million transactions.
Correct.
But it's a difficult one to read at the moment because Christmas has come early, effectively. It's really hard to read the market with a Christmas slowdown on top of the economic factors. So trying to find the base level of prices at which the mass market will do transactions when they're just sitting back and seeing what happens is really hard. So hard to read prices, but I think hard to read transactions too.
What's a healthy number for sales transactions for the industry? Because you spoke about the peaks, but what is kind of a comfortable, obviously we're not going to see it this year, but what is a comfortable level to sustain the market for people to feel optimistic but think, okay, we have to work, but it's comfortable?
Yeah, it's million plus.
And so when do you think that will be, when will that come?
I think we'll probably sit around that level.
Yeah.
I'm not as. I think you've already got one thing to forget is there is still momentum in the market at the moment. There is a natural softening and a rebalance, shall I say? But there is still a demand of people that need to move and people that have changing working environments, more people working from home. We're still seeing that filtering through the system, and equally, I think let's not forget the other side of the scale. This past year has been the lowest number of repossessions, in history. So, in the financial crash, we were looking at 10 times the numbers that we're looking at the moment. Are we expecting to get to that kind of level again? I don't think we are. So I think there are choices people need to make, and I don't know about anybody else, but I regularly go to restaurants and bars and pubs, and I struggle to find them empty very often. People are still making lifestyle choices, which that will be probably an area which will see further impact, I would imagine, as the bills start to buy, as higher mortgage payments start to do. It's those nice things that people will make the decisions on before the fundamentals. People always instinctively look after their roof, they always look after their stomach, and they always look after their warmth. They're the three natural priorities that we do.
It's a good question, though, because I think I'm right in saying there have been times over the past 12 to 18 months where the industry hasn't had the capacity to deal with the peaks in demand, the energy certificates and all those things, and the valuations and so on. So when you get a surge in demand, it can be difficult. You don't want the opposite, a collapse in demand either. But
Do you think, Anonymous, this is from, do you think mortgage rates have stopped falling after the recent easing? Will they rise from now on depending on bank rates?
My view is they haven't stopped falling, and that they will. That there is. It depends on the time scale. I don't think they're going to fall all that much in the near term, but I think the prospect for this time next year we'll be looking at lower mortgage rates than we've got now, and perhaps quite a bit lower. But I think the fact, as I mentioned in the talk, some of the effects of September the 23rd are still with us, that gilt yields are still higher than they were. Interest rate expectations, even though the Bank of England has been trying to say that we don't need to raise rates as much as you think in the money markets, the markets are still a bit sceptical about that, so rate expectations are still high. So not much in the short term, but I think easing, by next year, by this time next year.
It's like they've metabolized the gilt rates coming down a little bit. They're meeting the base rate coming up at the same time. Yeah. But as base rate expectations now, David's telling us 4%. We were all thinking 6% 2 months ago. The lenders, when they're more confident, then the competition will start to be the best in the market to get the business, and that's when you start to see the rates coming down. They may only be available, the deals, I'm sure you'll all be aware, may only be available for a couple of days at a time, and then they'll come out again. But you want that competition for the lowest rate, and then you'll see the downward pressure.
Someone's asked, why would a first-time buyer look to buy now when mortgage costs have increased dramatically? Nathan?
I think when you buy a home, it's emotional. I think, the time that you do it shouldn't affect anything. And also, let's be honest, you're buying over a 25, 30-year period. And if you stand back and look at any trend, it doesn't matter where the interest rates have gone in the very, very short term. So for me, I think we should be encouraging people to continue to buy. And once you've got that property, you're there for the next 25, 30 years, you'll see higher rates.
Yeah, but that's an old argument. That argument hasn't changed over years. That was the situation when I was buying my first house 25 years ago. But what has changed is the premium, the relationship between what you earn and what you can afford, the house prices now, and the fear. There is a fear now of being in the housing market because younger people, say if you're in your 30s, you've seen financial crashes, you've heard about them, and now we're seeing higher interest rates and unstable government to a certain extent.
Conversely, I would argue they've seen their parents that bought now settled properties which they have more equity than they would have done had they been in rented accommodation. I also think when you look at the affordability, yes, mortgages are higher, but the affordability tests that now are put into mortgages are much, much safer than they were in our day. You know, we were giving people with very little money and they were earning 125% mortgages and no deposit. So actually, if a first-time buyer is in a position that they have a deposit and they have confidence in the bank actually doing its job to make sure that they're not overcommitting themselves, and they are stress tested to these levels, and based on the fact that if you look at the majority of the wealth for most people, it is their property is their biggest asset that sits there, would they rather put that monthly income into a rented property, or would they rather look to secure themselves for the future? Well, if I was a parent and I had a child that was considering whether to buy or not, I would certainly be helping them get themselves on the ladder. And
But lucky you to be in that position.
Not financially. I would physically.
I'm not having a go at you. I'm just kind of like,
I get what you're saying, but there will be people in this room.
I'll pick on someone else in a minute.
There will be people in this room, and I was no different. My first house, I didn't live in it on my own. I bought it and I rented out some rooms to my friends, and that's how I managed to get myself going. That was how it is. And you know, so for me, I think at some point you've got to jump in the swimming pool, and once you're in there, you actually find it's quite a pleasant environment and a fairly safe environment as well.
Sonia.
Is there an argument that we have to be realistic about the fact that we have had ultra low rates? We saw David's slide. It just was never going to stay that way. We all knew it, but it kept going on. We were like, oh, this is great.
But
we're going to go back to 2.5. I'm not saying that that's where they are now. But in a market like this as well, if you're dealing with an agent and you can get a good deal on a property, it's going to be property by property. If you can get a seller that's realistic about what's happening in the market at the moment and get yourself a good deal, then you know you're into, maybe you go to a variable to take advantage of any future falls that are coming. If this is a point at which you want to get onto the market, but I think we have to be realistic. I'm not sure. I'd be fascinated what David thinks. I don't think we're going back to 0.5% base rate anytime soon.
Yeah, I mean, it comes into this question, David, I'll get you to answer the question, but if you're not expecting a large drop in house prices, but you are expecting higher mortgage rates, at least in the short, medium term, there will be an impact on first-time buyers.
Yeah. I mean, one of the questions I get asked very often in this kind of period, particularly including by my own children, is should I wait to buy until house prices have fallen by 20 or 30%? And I always say that's a very bad idea, a very bad strategy. A, because they probably won't, but B, because if they did, it would be harder to get hold of a mortgage, because the lenders would then become much more cautious about lending into a falling and a weak market. So that's not a good strategy. But it does. One of the things that does worry me, and picking on Granya's point, is that many of the mortgages that are out there, many of the size of mortgages that are out there are pretty huge at the moment. You know, people have got mortgages. Young people have got mortgages that would make you wince in terms of the overall amount of it, and were predicated on interest rates staying low forever, and that does concern me. That is the vulnerability in the market. I think that people who've got, you know, mortgages of many hundreds of thousands of pounds and expected that rates would remain low forever, and I think that is where things are quite vulnerable at the moment. So I wouldn't encourage anybody to get locked into a very low mortgage. I think it's really important to sort of start by buying quite modestly if you can. You know, no, don't go in with the house you're going to live in forever at the outset. You know, big mortgages I think are a little bit dangerous at the moment, even though I'm reasonably optimistic about interest rates.
Miles?
Just say we have to acknowledge it's a very sad state of affairs. First-time buyers already felt disenfranchised from the housing market, and then this interest rate comes along, rising more quickly than anticipated. So a double blow for them, and really hard for agents to deal with that. So, and at the same time, costs of renting going up. So I'm not hearing back from agents that first-time buyers are delighted necessarily about the situation and potential house price drops. They're actually just really annoyed that they can't get on the housing ladder. They were close, and it's been taken away.
And it just came at the same time as Help to Buy ended. So their additional, easier route into new home ownership also ended at around the same time.
Yeah. We must talk about the rental market. I'd really like to hear you. A couple of questions, one from Graham, one from Rich. Same questions, really. Does the panel think more private landlords will sell up in 2023? What are your thoughts, John?
I think there will be private landlords selling up. Probably not as much as we might expect, but there will be people that are mature in the market that think, actually, it was my pension. I'm at the stage now where I can take it. I think particularly with the EPC rate coming in at 2025, and it's got to be a level C, category C, I think that's going to deter a lot of people, make them think, wow, I've got to spend quite a bit of money, £10,000 or whatever it is, to bring my property up to standard. So I think that will be a deterrent, and I think that will see people back out of the market because of that. We've got much more regulation coming through. And on the one hand, I think I really support that. In fact, I do really support that, because we need to have much smarter properties, and we need to make sure the standards are correct. We're a consumer-driven industry, and the best thing we can do is give our customers the best service and put them in the best homes, and make sure that whatever we let to them is the right standard, and they're going to enjoy it. And I think, the competition that's come in the market from the build-to-rent section, which is giving a really good standard, is got to drag it up by its heels. So I'm in agreement with all these things. However, it will have an impact. But maybe we'll lose some landlords that we don't really need in the market, and we'll bring more in that are, in tune with doing these things. I think that the biggest thing is, people, if they've bought recently for a buy-to-let and have a fairly sizable mortgage, then it's going to put pressure on when interest rates go up. And that's, I think, going to be the balance. And landlords will have to think, well, if the market's dropping, is it the right time to sell? So I think there'll be that element in, which will deter many from selling, because they'll sit back and wait and see. And then if the market comes back in, they'll probably relax off. So I think there'll be an element. I don't think it will be as shocking as we might expect. I think the rented sector is here. As I said earlier on, the demand so outstrips supply. It's incredible. And it's, 10 years ago, we'd talk about 6 tenants to every property and say, wow, it's 6 tenants. Today, this morning, it's 36 to every property. So we just have to be careful with rents. And I think, you guys out there have got to make sure your landlords don't become greedy and overprice everything. And I think it's about keeping your tenants happy. And a relationship with a tenant should be a good one. It's a working relationship between the landlord, the tenant, and the agent. And then you won't have problems, you won't have arrears, it's about managing arrears going forward. But, look after your tenants, have a good relationship, and I think we'll see a sustainable rented market carrying on. That's my view.
Additional factor coming down the tracks that's really, really worrying me is the flats and apartment sector service charges. Building Safety Act, fire regulations, lot of welcome tighter regulation to ensure tenant safety. But the costs of block management and adhering to all these new regulations are really going to make service charges rocket. So from a landlord point of view, a lot of them owned by buy-to-let landlords, whilst rents are going up, your net income is going to be going down, and the responsibilities that come with it too. 13,000 buildings in scope in the UK, apparently, that are going to be affected. So have a real look at the rented apartment, flat, buildings 11 metres and above sector.
You'd really be hoping that the government would have a joined-up view about the rental sector. It's doing a lot of heavy lifting due to the lack of social housing that's been built over the last 20, 30 years. There's a lot of demand there, and landlords are doing their very best to create good homes for tenants, and tenants obviously need decent homes and at an affordable rent. But the demand and supply imbalance that we have at the moment, how can it continue? So I think there needs to be a whole-scale review of what's happening for landlords in the rental market.
I agree, and I think let's not forget the majority of landlords are 1, 2 and 3 own property owners. They're not wealthy, they're not multimillionaires sat there. They are people very often that were accidental landlords or have small portfolios they've built up. They don't have vast means at their disposal. And equally, I think you've got to bear in mind that a lot of the environment that was there 15, 20 years ago, and a lot of people bought into that, has been stripped away. You've lost your interest relief on your mortgage. You're taking away capital gains tax allowances are being filtered away, and people generationally, to your point, John, there's a lot of landlords that bought in one period of time, and they are getting to the end of that life, and we're already seeing our members reporting landlords are selling. And we've had predictions as much as 20-25% of their portfolio they feel are at risk with landlords potentially exiting a market. And the environment for new landlords buying in isn't so healthy because you're paying a lot more for the property. Yes, the rents have gone up, but the yield overall is down, and the cost of borrowing obviously is higher. So you're reliant on those older landlords that have fairly low borrowing to actually function in that marketplace. So removing those out, for me, is an area of concern.
How much do you think rental prices, this is a question again from Rich, can increase to combat these growing interest rate costs? I mean, what's realistic to predict?
We saw David's chart there earlier. It has the kind of overall rental increases. That includes where landlords and tenants are coming to agreements and then the tenants are staying put. But just for new lets asking rents, they're growing much higher. We're seeing double-digit growth. I'm not sure that level can continue. Now, it's a little bit woolly in the rental market because if you can't afford the 3-bed flat, you might be tempted to go for the 2-bed. So the affordability ceiling is just not as clear, but there's just going to be a point where that affordability ceiling is hit. So we're still seeing rental growth next year, but it will be down in the single digits. I just don't think we can carry on with that double digit. For new lets, that's where you're seeing the big growth, where people are moving into new accommodation.
And I think, sorry, Miles, I think
I was going to say you can have a rent freeze like in Scotland, then they don't grow at all.
This was another question, the introduction of rent controls in Scotland. Do you think that will come down to the rest of the UK?
Let's hope not.
Sorry.
Let's hope not. I think
we'd be naive to think that those discussions are not taking place and people are considering that out.
It is something we'll put to George Osborne, don't worry.
And you can't always believe what politicians say, but the Housing Under Minister was at a talk that I was at in Coventry, National Landlords Conference last week, and she said rent freeze in England is not on the cards. But take that at face value.
If we wanted to deter landlords from the market, then that would be Section 21's removed, rent freeze. I think we'd be in a more of a difficult position. And the housing market is reliant, or the rented market is reliant on private landlords because the build to rent and social housing doesn't meet the needs, and so that's why we've got such demand. So the government, as you say, need a joined up view on this to make sure we don't lose private landlords, and they need to encourage them, not deter them. We need to keep that stock, because I dread to think what would happen if we had a 20% drop in the private rented sector. Where would people live? I mean, that's going to be a real issue, so, yeah.
Okay, I've got 2.5 minutes left. That gives you 30 seconds each to say for a reason to be optimistic moving forward for the next 6 to 12 months. Miles.
So, hot off the press this morning, buyer leads on Rightmove are down 30% on 2021, same period, but they're still up 1% on 2019, which was a more normal market.
John.
I think the things we heard this morning earlier from David, the outlook is not as gloomy as we were thinking. So, and that's where I am. So it should be good.
So it's crap, but it's not that crap.
It's crap, but it's not that crap.
David.
Yeah, I think we shouldn't get carried away that because it's because often the mood is quite important, and as I was showing, consumer confidence is pretty battered at the moment, and that does feed into what you're seeing in terms of potential buyers coming into the market. People have been quite frightened off by what we've seen over the past couple of months, I think, and so it will take time. I mean, we need, as Grania said, we need a period of stability. We need a period where dysfunctional government is not making the lead on the 10 o'clock or 6 o'clock news every day, and that's already starting to happen. Maybe other things which make us depressed are leading the news, like strikes and so on. So I think it's going to be a pretty gloomy winter, even though I wasn't excessively downbeat. So I think it's a question of getting through a difficult few months, and then things will settle down. Spring. Let's hope for a spring upturn. Yeah.
Indeed, Nathan.
I reiterate, I am optimistic. I think the levelling out actually is probably the best thing that could have happened, rather than a stupendous crash, really. I think for good agents, to prepare themselves for next year. I think gives a lot of opportunities. The one thing we're forgetting is we didn't want 36 people for every single house that came along, and we didn't want 20 odd people for every sale property. Actually, you need one buyer or one tenant. So actually to be more manageable, to be in a position where, yes, there'll be less people looking around, but actually the quality of those people will be better. That's actually what we really want. We want good quality buyers, good quality tenants, and be able to help them find the right homes. And so actually overall, I think people will benefit, vendors will benefit, and landlords will benefit from a slower environment where we can actually do our job properly. So actually, by and large, I'm comfortable where we are.
But we do need to build a lot more houses,
indeed.
affordable houses,
and
for sale and to rent.
And for that point, and I'm sure you'll say, that's only going to happen when you can pull all those parties together and you can get them to commit to a 10, 15-year housing plan that isn't being varied by different administrations and governments coming in. It's got to be, that's what we're all signing up to, and that's not going to change. We're in this position because 15, 20 years ago, people wouldn't do it, and everybody kicks the can because they're only there for the short term. This is never going to get easier. This is all going to get worse. That's the reality, unless there is that, the population's growing, migration's coming into the UK. The numbers are pint of sand, half pint glass. It doesn't all fit, So unless you build a bigger glass or you get rid of half the sand, it's not going to work. So from my point of view, it needs that kind of action if we're going to sort this problem out.
Grania, you get the final word.
Just in the shorter term, my reason for optimism is it's going to be challenging next year, cloudier economic outlook, but the OBR is now saying the Bank of England is too damn beat. This is the kind of conversation you want. We've been prepared for the absolute worst, and everyone's saying it's not going to be as bad as that. So that's my feeling, that we'll get stability as we move into Q1, and then we have a year of a kind of solid year for the rest of the year through 2023.
Miles, Grania, John, Nathan, David, thank you all so much for your insights, and thank you for your questions as well.